Valens Research, Uniform Financial Analytics.
For S&P Global, if you look at this company, you think that S&P Global was a 19% ROA firm. Actually a pretty impressive return. That's pretty robust. But what you wouldn't realize is it's actually 5 times higher. It's actually 89% is what the real ROA of S&P Global is when we remove the accounting noise. And not just that, S&P Global hasn't been having an ROA that's around 17 to 19% for the past 5 years. In fact, in the past 4 years, S&P Global has seen operations ramp up massively. Returns have expanded from 50% to 90%. They've almost doubled, right? If you're looking at the as-reported accounting metrics for S&P, you think that you've got a stable, a healthy and robust, but stable and boring business. In reality, what's going on with S&P is you're seeing a real fundamental acceleration in that business, right? That's the first thing that we're looking at here. Before we get to these bars, which we'll get to in a moment, we do the exact same thing with asset growth, where we show these orange bars, which are the distorted as-reported asset growth for the company, and the blue bars, which are the uniform accounting adjusted true blue asset growth for this company, right? You can see S&P's investment cycle has been much more volatile than the as-reported metrics should reflect. That helps give us a sense of what the performance is of the business, right? Really, when you think about it, when you think about these two charts are really showing you in a different visual way what's the free cash flow of the business, right? Because you can think of the operating cash flow of the business as being what the return is that the business is throwing off. And you can think of the investment, right, the CapEx in a free cash flow analysis, but we think about total investment in a firm as the asset growth, right? So think of this as the arrow up for cash flow, and think of this as the arrow down for cash flow. And so what you're looking at here is specifically we've got a company where we're trying to understand what cash flow is, and we can see because of how returns are so robust, right? Even this year, this company grew at 39%. In reality, though, the blue bar shows that the real return of the business was 90%, though, meaning it was throwing off free cash flow even when it was growing 39% this year. But it's not just about performance that we care about. We also care about valuation, right? It's not just is the company a good company or bad company. It's does the market know, and is there an opportunity here to invest? And that's where VA and VE come in. VA is our cleaned up, adjusted price to book asset metric. That's the blue bar here compared to the orange bar, which is the distorted as reported VE, right? Price to book equity for S&P. And you can see the price to book equity number for S&P Global is all over the place. It's up, it's down. I mean, it's up, it's 136 times now. What do you even make of that? In reality, though, when we look at the blue bar, what we can see is a steady rise higher in valuations in this business because of the fact that the market understands this company doesn't have flat ROAs. The market understands that returns to this business are rising. And since they know that, the market is paying more and more of a premium for this business. The fourth chart here is VE, right? VE is our cleaned up, adjusted PE for this business relative to the as reported PE. Again, same idea. When you look at the as reported PE for this business of 25 times, above market average valuations right now, you say, why is the market paying a premium for a company whose returns are basically flat and who really is only growing time to time from acquisitive growth? And what we can see here is in reality, the market's paying a premium because returns are ramping for this business. The market understands this is a growth company with improving returns that's still actually investing, and it's paying a premium. This last chart here is TSR relative to the market. What does that mean? Total shareholder return is the total return that an investor who bought the stock would get between capital appreciation, the stock rising, and dividends, how much you actually get in income in your pocket. The combined of those two gives you your TSR. And so TSR relative to the index, what does that mean? It means this chart isn't just the stock performance of the company. It's how the stock performed relative to the market. When this line is flat, like it was from 2015 to 2016, that means the company performed in line with the market. When it rises, like it did from 2016 to 2017, that means the company outperformed the market. When it falls, like it did from 2006 to 2007, that means the company underperformed the market, right? The market did better. And what you see, which is really powerful, is there is a phenomenal relationship between the uniform accounting returns and growth of companies and what we see with TSR relative to the market. A phenomenal relationship that, by the way, does not appear at all when you look at the as reported accounting metrics that basically make it look like a garbage in, garbage out issue where you don't know why the market is moving up and down because the returns don't represent it. But that understanding of historic profitability and valuations isn't all you get from this chart. And this is where this chart becomes really, really powerful. This page of our app is after these blue bars and orange bars, which are the history, we get into the future. These two light blue bars, that's what the market is pricing in for S&P Global what analysts are forecasting for S&P Global right now. Right? Sell-side analysts, when we take their consensus estimates and we push them through the uniform accounting framework, we can understand what are they forecasting for a real return for this business. For S&P, they're forecasting returns to jump massively, right? From 90% last year to 120% the next 2 years. But then what's also even more powerful is these white bars. These white bars are what the market is pricing S&P Global to do at the current valuation for the company. At S&P Global's currently $60 billion market cap, the market isn't just pricing in this upgrade in returns the company is forecast to see. The market is pricing in returns to continue to expand even more. Right? The market's pricing in right now growth of this company's returns to rise from 120% next year to 170%. Right? That is a massive expansion. Now, the company's already done that, right? Rising from 50% to 120%. So maybe they could, but the important thing to understand is even if the company does do that right now, that says the market already understands what the company is going to do, so it may not be that undervalued, right? It's a great company. It's a robust, improving company, but it's not undervalued, and these white bars help us understand that. Now, what I'm going to do really quick, just for S&P, and then we'll move on to the next company that we're going to highlight, is I'm going to actually show you what the company might be worth, right? So let's say that we think that S&P, right, most of this growth, this shrinking and rising, is really significant amount of it is acquisitive. So let's actually say they're not going to grow organically at all. But let's also say on top of that, we think that because of the fact that most of this expansion was because of the synergies they got from bringing together different businesses and selling S&L's products on top of S&P's products, et cetera, et cetera, et cetera. Well, what happens if we think that is actually going to plateau? Right? We think that returns aren't going to expand. We think that returns are going to stop expanding after 2020. If we thought that was the case for S&P, if we thought this was a reasonable scenario, S&P is worth 35% less than its current stock price. Right? And this is a kind of powerful, quick scenario analysis that we can do using the Valens Research app. And this is the power. Not only is this Valens Research app give you the ability to understand the historic performance of the business, it also gives you an understanding of what the market is expecting the company to do in the future, and if market expectations are too high or too low, and what that means the company is worth if the market's wrong. Right? Because the most important thing, if you talk to the great investors, everyone from Buffett to Klarman to Bill Miller to Einhorn, et cetera, all of them will tell you you need to start with understanding what the market's thinking. And once you understand what the market's thinking, then you can start to understand whether or not you have a divergent view and the company might be undervalued or overvalued.
Valens Research, the world's leading source for uniform financial analytics.